G'day guys, and welcome back to the VEMA Trader Expected Value series. My name is Reese, and in today's video, I'm going to be running you guys through what expected value is when it comes to trading. So last week, we spoke about what expected value was in terms of a coin flip, right? Just a really intuitive way for me to sort of show you guys what expected value is and why the calculation is such a valuable thing to know. This week, we're going to be looking at it in terms of trading specifically. So we are currently looking at VEMA's Analyze screen. And you will notice that on your Analyze cards, the very first metric that we show you guys is the expected value. There's a very good reason for that, and that is that, in my opinion, expected value is the single most important metric we can show you guys, because it's a metric that tells you instantly whether a trading strategy is profitable or not. How it does that is you either have a positive expected value, in which case your trading strategy is profitable, or you have a negative expected value, in which case your trading strategy is unprofitable. So it is a super simple way to figure out, are you making money with a given strategy? If we take a look at my all strategy, right, all of my trades combined, I have an expected value of 0.57, and you can see that that is profitable because it is a positive number. That is why VEMA says profitable, yes. However, if we come down and look at all my losses, you would expect to see a negative expected value here, and indeed that is exactly what you see. Because it's all my losses, right, you would expect a negative expected value because I am losing money on those trades. That is what a negative expected value says. And so VEMA is saying profitable, not yet, because it is possible to turn an unprofitable strategy into a profitable one. Obviously, that's impossible when your tag is losses. It just cannot be done. But for some other examples, you can do it. And I'm going to speak about how to do that in another video that'll be coming in a couple of weeks. So, really quickly, what you want to be doing is taking more trades with positive expected value and taking less trades with negative expected value. So if I come down to my bottom two cards, right, where we start to get into real strategies, I can see that on my 15-minute shorts with a bias, right, where I have tagged the 4-hour bearish bias and I've taken shorts on the 15-minute time frame, I am profitable, right? I have a 0.53 expected value. Now, that 0.53, what the number actually means, I'm going to tell you guys more about that next week and really get into that. For now, we're just going to focus on profitable or not, essentially. So I can see that that is a profitable strategy. What I want to be doing is taking more of those trades because I know those are the trades that are making me money. However, if I come down and look at my Tuesday tag, I can see that I have a negative 1.1 expected value. I am not profitable or not yet profitable, which means that I am losing money. On average, when I trade on a Tuesday, I lose money. So a really quick and easy thing to do is just stop trading on Tuesday, right? If you notice you have a tag that is negative expected value, stop doing that thing and you will likely see better results in your trading. It's just such a quick, simple way to identify flaws in your trading and also how to identify more of what you want to see, right? I now know that my 4-hour bear bias is working quite well for me, so I want to be taking more of those trades. Now, how do we actually calculate the expected value? Well, we remember from last week that the expected value formula is equal to the probability of a win times the result of a win minus the probability of a loss, times the result of that loss. So how is expected value calculated in trading? Well, luckily for you guys, I have prepared a little something. So we have to think of equivalence for each step of this formula, right? Which is not super hard to do. So when it comes to the probability of a win, that is essentially the same thing as your win rate, right? Your win rate for a given trading strategy is telling you what is the probability of you winning. If you are winning 50% of the time, your probability of a win is 50% or 0.5 if you want to keep it as a decimal. The next thing we need to know is the result of a win, right? The result of a win is essentially your average achieved fee adjusted risk to reward, right? That fee adjusted is very important because we know that fees are part of your profit and loss. So we really need to take them into account when we calculate your expected value. And luckily for you guys, that is something VEMA does, right? It simplifies this whole process so much. And so you are getting a very accurate expected value because it's taking into account what did you actually make on the trade in terms of, if your take profit was hit, what did you make? Excuse me. But then it is also factoring in, well, what were the fees that you paid? So you might have made, $300 when your TP was hit, but if you lost $50 to fees, you really only actually made $250. Now, none of these calculations are done in dollars. They're all done in sort of risk to rewards and those sorts of things because it makes it much smoother and much more applicable across different strategies and different things, right? If they were all being done in dollars, it's kind of harder to compare them because you might be using different account risks and things like that for different strategies. So by sticking them all to risk to reward, it makes them all super easy to compare. Now, the next thing we need, we've got our probability of a win, we've got our result on a win, so we need our probability of a loss. Well, we can get that really easily because all that is 100% minus your win rate, right? So you can imagine if you had a 100% win rate, then your probability of a loss is 0%. You never take losses. If you have a 50% win rate, then your probability of a loss is going to be 100% minus 50%, which leaves you at 50%. So we have that figure as well. And finally, the figure that we need is the result of a loss. Well, you might be able to guess that similar to the average achieved fee-adjusted risk reward, we can use the average loss. So if you move your stop loss, into less of a loss, that's going to be factored in. You're not necessarily going to be taking a complete 1R loss on every trade. And indeed, on some trades, you actually might take more than a 1R loss due to slippage or other factors like that I've spoken about in the scalping series. And then, of course, we also include the fees on your loss because, again, they factor in to your P&L. So that is how we calculate the expected value of your trading strategies. Righto, so hopefully that helps show you guys why expected value is such an important metric and also how we calculate it. Stay tuned because next week I'm going to be explaining what that figure means, that 0.53 that we were looking at before. And the following week, I'm going to get into how to improve on unprofitable strategies, but also how to improve on profitable strategies. Have a great day, happy trading, and I'll talk to you very soon.